The biggest lie in real estate is that you absolutely need a 20% down payment to buy a home. It's a myth perpetuated by outdated advice and often costs hopeful buyers years of waiting, delaying their entry into homeownership. Imagine you're eyeing a $350,000 house. A 20% down payment means saving a whopping $70,000. For many, that's an impossible hurdle, leading them to believe homeownership is out of reach. But what if I told you that most people actually put down far less and often for good reason? The truth is, while 20% does offer some advantages, it's far from a requirement, and in some cases, it's not even the smartest financial move. You could be throwing away money on rent for years, waiting for a number that's not even necessary. So, what's the real minimum you need, and what are the hidden costs that matter more? So, if 20% is a myth, what's the actual minimum? For many conventional loans, you can put down as little as 3% to 5%. On that $350,000 home, a 3% down payment is just $10,500, a significantly more achievable goal than $70,000. Then there are government-backed loans. An FHA loan, popular with first-time buyers, requires only 3.5% down, which is $12,250 on our example home. And for eligible veterans and active service members, VA loans often require absolutely zero down payment. Yes, zero. This changes the game entirely for millions of Americans. These lower down payment options make homeownership accessible much sooner, but they do come with a trade-off. Understanding these different minimums is your first step towards getting into a home without unnecessary delays. But there's a crucial cost associated with putting less than 20% down that you absolutely must understand. The trade-off for a lower down payment on a conventional loan is private mortgage insurance, or PMI. Lenders require PMI when you put down less than 20% because it protects them in case you default on your loan. Think of it as an extra insurance premium tacked onto your monthly mortgage payment. For a $350,000 home with 5% down, $17,500, your loan amount is $332,500. PMI can range from 0.3% to 1.5% of your original loan amount annually. Let's say it's 0.5%, that's $1,662.50 per year, or about $138.54 added to your monthly payment. While it's an extra cost, it's often significantly less than the rent you'd pay waiting years to save 20%. The good news? PMI isn't forever. Once you build up enough equity, usually 20% of your home's original value, you can request to have it removed. But what about government loans? Do they have a similar cost? FHA loans also have a form of mortgage insurance, but it's called a mortgage insurance premium, MIP. It actually has two parts, an upfront premium and an annual premium. The upfront MIP is 1.75% of the loan amount as of 2026, which can be financed into your mortgage. So, on a $350,000 home with 3.5% down, your loan is $337,750, and the upfront MIP adds another $5,910.63 to that. The annual MIP is typically 0.55% of the loan balance, as of 2026, paid monthly, which is about $155 per month for our example. Unlike conventional PMI, FHA's annual MIP generally stays for the life of the loan unless you put down 10% or more, in which case it drops off after 11 years, for loans originated before June 3, 2013, or if the loan-to-value ratio is 90% or less at origination. For most FHA loans originated after June 3, 2013, the annual MIP remains for the life of the loan regardless of the down payment. VA loans, however, are unique. They don't have monthly mortgage insurance. Instead, they have a one-time funding fee which can be financed. It varies based on your down payment and prior VA loan use, typically 2.15% to 3.3% for first-time users with zero down, as of 2026. This structure often makes VA loans incredibly attractive, but you still need to prepare for other upfront expenses. Beyond the down payment, the biggest surprise for many first-time homebuyers is closing costs. These are the fees paid at the end of the transaction to various parties involved in the home sale, and they can easily add up to 2 to 5% of the loan amount. On our $350,000 home, That's an additional $7,000 to $17,500. What do these costs include? Everything from lender fees, origination fees, underwriting fees, title insurance, escrow fees, appraisal fees, credit report fees, recording fees, and prepaid expenses like property taxes and homeowners insurance. These aren't optional. They're a mandatory part of buying a home. It's crucial to budget for these separately from your down payment. Imagine you've saved your $10,500 for a 3% down payment, only to find out you need another $10,000 just for closing costs. That's a deal breaker if you haven't planned for it, which leads us to a critical mistake many buyers make. Here's what happens if you only budget for the down payment and ignore closing costs. I once saw a buyer, let's call her Sarah, who was so focused on hitting her 3.5% FHA down payment for a $300,000 condo, about $10,500, that she didn't account for anything else. She saved diligently, hit her target, and found the perfect place. Her loan officer gave her an estimate of closing costs, but Sarah, overwhelmed, didn't fully grasp their significance. Fast forward to the week before closing. She had her $10,500 ready, but the final closing disclosure showed she needed another $12,000 for various fees and prepaid items. She was short $12,000 with days to spare. Panic set in. She had to scramble, borrow from family, and nearly lost the deal. This mistake almost cost her the condo and the non-refundable Earnest money she'd put down. Don't be Sarah. Always budget for closing costs in addition to your down payment, and there are ways to minimize these costs too. While closing costs are unavoidable, there are strategies to reduce them. First, shop around for lenders. Different lenders have different fees, and comparing loan estimates from at least 3 different companies can save you thousands. Second, negotiate with the seller. In a buyer's market, or if the house has been sitting for a while, you can sometimes ask the seller to pay a portion of your closing costs. This is called a seller credit or seller concession. For example, on that $350,000 home, if closing costs are $10,000 and the seller agrees to pay $5,000, your cash to close drops significantly. Third, consider a no closing cost loan. This isn't truly no cost. Rather, the lender charges a slightly higher interest rate in exchange for covering your closing costs. Over the life of the loan, you might pay more in interest, but it dramatically reduces your upfront cash requirement. Knowing these options can make a huge difference in your total cash needed at closing. But remember, the market conditions play a big role. Beyond the lender and title fees, a significant portion of your closing costs are often prepaid expenses. These aren't fees for the transaction itself, but rather payments for things like property taxes and homeowners insurance that you pay upfront to cover a certain period after closing. Lenders typically require you to prepay several months of property taxes and homeowners insurance, which then get held in an escrow account. For instance, if your annual property taxes are $4,200, $350 per month, and your homeowner's insurance is $1,800, $150 per month, you might need to prepay 6 months of taxes and 12 months of insurance. That's $2,100 for taxes and $1,800 for insurance, totaling $3,900 that you need to bring to closing. These are legitimate costs of ownership, but they often surprise buyers who haven't factored them into their upfront budget. It's not just the down payment and fees, it's also about getting a head start on your ongoing home expenses. Another upfront cost that often gets confused with the down payment is the earnest money deposit. This is a good faith deposit you make shortly after your offer is accepted, usually 1 to 3% of the home's purchase price. On our $350,000 home, that's $3,500 to $10,500. It shows the seller you're serious. This money is held in an escrow account and is credited towards your down payment or closing costs at the closing table. So, it's not an extra cost, but it is cash you need to have available very early in the process. If you back out of the deal without a valid contractual reason, you could lose your earnest money. But if the deal falls through due to, say, a failed inspection or appraisal contingency, you typically get it back. Understanding earnest money is vital because it's the first significant chunk of cash you'll put down, often within days of your offer being accepted, not weeks before closing. Let's put it all together. For a $350,000 home with a 5% conventional down payment, you'd need $17,500 for the down payment. Let's estimate closing costs, including prepaids, at 3% of the loan amount, or roughly $10,000. So your total cash to close would be approximately $27,500. Compare that to the $70,000 for a 20% down payment. If you're using an FHA loan with 3.5% down, you'd need $12,250 for the down payment, plus let's say $12,000 for closing costs including FHA's upfront MIP and prepaids. That's $24,250. This is the crucial number. Your total cash to close, which includes your down payment, closing costs, and prepaid expenses, minus your earnest money deposit. It's essential to get a detailed breakdown from your lender, known as a loan estimate, early in the process so you know exactly how much you need. But there's one final, often overlooked, cost that can make or break your ability to qualify. Beyond the money needed at closing, many lenders require you to have cash reserves. These are funds left in your bank account after closing, typically enough to cover 2 to 6 months of your mortgage payments. Principal, interest, taxes, and insurance. This isn't money you spend. It's money you have. It proves to the lender that you can handle unexpected expenses and are less likely to default on your loan. For a $350,000 home, a typical mortgage payment might be $2,200. If a lender requires 3 months of reserves, you'd need to show you have $6,600 still in savings after you've paid your down payment and closing costs. This requirement varies greatly by loan program and your creditworthiness. While it doesn't add to your cash to close amount, it absolutely impacts your eligibility and is a critical piece of the financial puzzle. Failing to meet reserve requirements could mean your loan application is denied, even if you have the down payment, so always ask your lender about their specific requirements. So, how do you prepare for all these costs? First, get pre-approved for a mortgage. This involves speaking with a lender who will review your income, debts, and credit, and give you a realistic estimate of how much you can borrow and what loan programs you qualify for. Crucially, they'll also provide a loan estimate detailing estimated closing costs. Second, start saving specifically for these 3 buckets: your down payment, your closing costs, and your cash reserves. Don't lump them all together mentally. Use online calculators or spreadsheets to track your progress for each. Third, explore down payment assistance programs in your state or city. Many offer grants or second mortgages to help with down payments and closing costs, especially for first-time buyers. Finally, work with an experienced real estate agent who can guide you through the process and help negotiate seller concessions. This proactive approach ensures you're financially prepared, but there's an ongoing cost of homeownership that many people completely underestimate. The biggest takeaway is that while 20% down is ideal, it's not mandatory. Focus on the total cash needed for down payment, closing costs, and reserves. This comprehensive approach will put you in a much stronger position to buy. Now that you understand the upfront costs, you might be wondering about the ongoing expenses of owning a home beyond just your mortgage payment. If you're curious about the true monthly cost of homeownership, including maintenance, utilities, and unexpected repairs, watch our next video on the hidden monthly costs of owning a home. And don't forget to subscribe for more straightforward real estate advice.